Hello students, this is C. Prabodh Naik here once again for lecture number 2 of security analysis. I'm sure whatever has been done in lecture 1 where I explained the basic concept of security investments, types of securities, types of investments and the analysis that we do before we start investing in a particular company's shares. We had done fundamental analysis, technical analysis. Then in fundamental analysis, we said that first we have to see economic analysis, then industry analysis, and then company analysis. Then we went on to technical analysis. And then we explained the concept of intrinsic value. Now, when we are doing security analysis, I think it is necessary that we do a little bit of analysis and try to understand the stock market, try to understand the movement in the price of shares, and what factors affect those particular movements. So today, it will be quite an interesting lecture where we, with the help of graph, with the help of diagrams, will see as to how the share prices are affected. What are the different diagrams that we can get? We get some very interesting diagrams. We get some very interesting figures and analysis. That is all what security analysis is all about. I'm sure you will enjoy each lecture as you have enjoyed the first lecture, and it will go on becoming more and more interesting, more and more scoring from the point of view of exam. And I'm sure you'll enjoy my lectures. And as I said, the PDF format of your entire book has been given to you on WhatsApp. So before you start with the lectures, before you start with my lectures here, video lectures, ensure that you are having the soft copy with you. Open to the page of security analysis so that as and when I refer to the book, you're having the book ready. Second, I also want you to be ready with a notebook, calculator, and a pen so that you can note down certain things. And as we are doing calculations, you can also make the calculations on your calculator to confirm. Any queries can be put in the comment box below the video, which is given. So you have the comment option. So anything that you have not understood, any problem that you are having, you can let me know through your comments. And also, if you like the video, if you like the lectures, please comment that lecture was good, lecture was not good, anything that you have not understood, please comment over there. Make it a point so that I know that all of you are actually students, human beings, and because I have not seen you as yet, and we have not met each other, so I should know. You can see me, but I can't see you. So I should know that there are some students who are watching my videos, who are enjoying my lectures. So even if it is good, don't feel shy to write over there that it is a good lecture, that you enjoyed the lecture. Okay, so we start with lecture number 2 on security analysis. Hello. Now, in security analysis, the first thing that we will be doing is, if you can see the chart that I have put up is of Sensex, and we can see as to what has happened to Sensex over a period from say 1993 up to 2013, 2014. Now what you can see is that the Sensex, which is the index, which is made up of the topmost 30 companies, takes into consideration various factors. And these companies which are included in the Sensex have their shares also listed on the Sensex, in which case the movement of the stocks comprising the Sensex determines the movement of the Sensex. Now what I want you to notice over here is that there are ups and downs that are taking place. Now here there is a down, sorry. In this case here you find that there is a down. Then it is going up again over here, it is on top. Then it is coming to the bottom down again. Then it is going on increasing. Here there is a small dip. Then there is a further increase up till here. Then there is a big downfall. Okay. Now various factors which are contributing to this. There was a stock market scandal that was discovered something around between 2000 and 2001, as a result of which, this slope came down over here and it was going down. Okay. And then it went to the rock bottom. Now here it was a year in which the terrorists had attacked US. Then we came up to UTI crisis was also there. That means three things contributed to this downfall. This particular downfall was contributed by three factors: stock market scandal, Harshad Mehta, UTI crisis, and a terrorist attack in the US. Then it went up again, and during the elections over here, you found that there was a dip because there was uncertainty as to what would happen, who would be forming the next government. This was in 2004. And in 2004, the Congress government came back to power. Of course, it was an alliance of Congress led alliance, UPA, which came into existence for the first time. We had UPA 1, and this went on up to this particular point. It was at its highest. So the UPA government led to the increase in the stock prices. And subsequently, what happened was that there was a big crisis in US that took place, which was of Lehman Brothers, one of the topmost financial institutions. Like we have ICICI, we have HDFC. So like that, one of the topmost financial institutions in US, that is Lehman Brothers, they filed for bankruptcy overnight. They filed for bankruptcy, and as a result of that, the entire financial economy of US went into toss. And likewise, all the financial institutions or all the financial markets that were related to the US markets, that were connected to the US markets, all the markets are connected to the US markets. All the markets are interconnected with each other. So a small dip or a small change in one particular financial market will affect all the other financial markets. So as a result of that, what you can see over here, there was a down slide. There was a slide over here. This slide because of the Lehman Brothers. And then there was a further slide over here. It went so deep because there was a terrorist attack in Mumbai, right? So because of all these factors, there was a total uncertainty. There was total panic as to what will happen to the economy, how the government is going to react to this, what will happen to those people who have lost their lives, and the the impact of the terrorists on the state of India. So all these were the points that were coming into the minds of investors. There was instability, there was uncertainty, and there was a lot of chaos and confusion. As a result, the stock market fell, and then there was a gradual increase. Why? Because now here the Congress government, that is the UPA 2, came into existence, and again it picked up again. So there was some stability in the market. Again it picked up. There was some confidence that things will be good. Okay. Then there was a lot of scandals that took place in during the UPA regime. That is the second regime of UPA. As a result of that, the corruption and everything, all the negative news was coming in, the markets fell. And then again in 2013-14, here the elections are there in 2014. What you can see here, pre-poll surveys showed that NDA is going to come back to power with Narendra Modi as the head of the government. So the things started increasing. And you know that in 2019, that is if I draw 2019, this particular market went further up and it touched 40,000. So it was at 2,500 here when we started, but it went up to 40,000 here. So various factors lead to the change in the stock prices. Various factors lead to the change in the prices of different companies. Government policies, change in government policies, taxation policies. So all these things lead to changes in the prices of shares. So this is one particular example or one particular chart that we have taken. Today I am going to do in security analysis one important theory, and that theory is called as the Dow Jones theory. Okay, it is called as what? It is called as the Dow Jones theory. So in the Dow Jones theory, we have to know what all important things are there to be learned by us. Okay, important points. So I have summarized the entire theory in point form. And what are the most important points that we will see as we are doing the Dow Jones theory? Okay, so let us come to this Dow Jones theory part. Okay, what do we have here? The Dow Jones theory, or the Dow theory in short, is one of the oldest and most famous technical tools. To understand the stock market, to understand the movement in the stock market, it is important for us to know the movement of the stock, why it is taking place, what is the impact of that, what is the implication of that, what does it imply. An upward movement, does it mean that things are good? A downward movement, does it mean that things are bad? And when I invest in the stock, whether I should invest for a short period of time or for a long period of time. So all these factors make a lot of difference on the price of the shares. Investors are very sensitive to market information. A small information. Now, what has happened, you see, since the time the COVID has affected people all over the world, what has happened to our stock? Have you seen? Have you kept a record of that? Have you kept a track of that? From 40,000, the Sensex has now come down to 20,000, 30,000. It is between 20 and 30,000. From 40,000, it has come down. So by more than 20,000 points, we have lost. So impact of a particular situation, short run, long run, is it going to always now remain at 20, 23,000 or 25,000? No, it is going to pick up. So there is a short run, there is a long run. So we have to see the movements of the stock, of the Sensex, of the Nifty in relation to short-term movements, long-term movements, and then interpret. So nobody can directly jump into the stock market and start buying the shares or start selling the shares. We have to understand the market, the pulse of the investors. We call it as the pulse of the investors. So we have to understand the pulse of the investors. We have to understand the mind of the investors. Then only we can start entering into the stock market for doing any trade. Okay. Now, the Dow theory is credited with having forecasted. What did they forecast? The great crash of 1929-1930. There was a great depression of 1929-1930. So now, as per experts, as per the World Bank, report has come just today morning, that the world economy is going to be suffering worse economic crisis as compared to the great crash of 1929. What is the meaning of this? That means our economy is going to be very badly affected because of COVID. There will be depression, there will be recession, there will be downfalling of the economy. So unemployment will increase. So what are the factors now that we need to understand how it is going to affect the stock market, how it is going to affect the share prices? Okay. So now according to Dow Jones theory is made up of the main crux of the theory, the main part of the theory is that all the stock movements of the stock market can be of three types, or can be classified into three categories, or there are three types of movements. Okay, so what he has said, that there are three movements all going at the same time. So now let us see the movements that they are talking about. What movements they are talking about? They are talking about movements which are called as, first, the primary movement. Then we have the secondary movement. Okay, primary movement, secondary movement, and then the third movement. So if I'm talking about primary movement, what is the meaning of primary movement? The primary movement, or the first movement, is the narrow movement from day to day. What is this? Day to day. What we have to remember? Day to day. Day to day movement. How much the prices have changed from yesterday to today, from today to tomorrow. like that. The first is the narrow movement from day to day. Okay, so that is an indicator. Now, though it is a day to day movement, it is an indicator of how the stock market is going to increase or how the stock market is going to decrease, or other whether it will increase or whether it will decrease. Okay, that is the primary movement, the first movement. The second movement, the second movement is the short swing running from 2 weeks to a month. So the period, you can see the period here, 2 weeks to a month or more. So the first movement, or also called as a primary movement, this is going to give you the long range cycle or the long term effect of the entire market, whether it is going to be a bull market which is increasing or whether it is going to be a bear market which is going to decrease. So now I'm making use of certain terms over here. I've said what? Bull market and bear market. I will be coming to this. Okay. So for the time being, I'm just using these terms. We'll come back to this. In short, you have to remember now, bull market means that the market is increasing. Bear market means market is decreasing. So the primary trend, that is the day-to-day movements in the stock, is an indicator as to where the market is moving. Whether the market is moving upwards, which means bull market, or whether the market is moving downwards, which means bear market. Okay, so there may be some reverse trend also that may come. That means as the share prices are increasing, suddenly you may find a small dip that is also happening. That is a short swing. That is a short swing. Okay, so the primary trend or the initial trend that is going to be shown will indicate as to whether the market is a bull market or a bear market. The third is the main movement, covering at least how much? 4 years in a direction, in duration. 4 years in duration. The first movement, primary trend, primary movement is an indicator, day-to-day movement is an indicator key what is going to happen in future. Second movement is the short swing that is taking place over a period of a week or 2 weeks or a maximum month. Okay. And then the third movement is the main movement, which is carrying at least over a period of, you can say, 30 days, or sorry, 4 years, 3 years, but more than a year, more than one particular year. Okay. So we have got three types of movements. So you have to observe in the stock market, you have to observe what? The movements, the day-to-day movements, the weekly movements, and the overall movement over a period of 3 to 4 years. Okay. Now let us come to each one of them. Primary trend. What did I say? Primary trend means the first move. It is an indicator of the long range cycle that carries either the entire market up, which is called as bull market, or the entire market will come down, which is called as a bear market. So the first step, the day-to-day movements that is taking place, increases by 20 rupees, increases by 25 rupees. Then tomorrow it may increase by another 10 rupees. Okay. So those movements which are there, the primary movements from one day to another day, they will indicate, they are an indicator as to whether the overall trend is an upward trend or a downward trend. Upward trend, if it is there, then it is a bull market. Downward trend, if it is there, it is a bear market. Okay. Primary movements indicate the basic trend. So this is what I told you. It indicate the basic trend in the market. However, in the short run, what will happen? Some reverse trend may also be observed in the short run. But in the long run, they will end up either with a rise or a fall in prices. So as I told you, it can move either totally upwards or totally downwards. But in that totally upward movement, there may be a small downward movement. Or in the totally downward movement, there may be a small upward movement. So that may be there. But overall, what is going to happen? See, the prices may increase first day by 20 rupees, second day by another 30 rupees, the third day by another 20 rupees, fourth day it may fall by 5 rupees, fifth day it may fall by 2 rupees. So the fall is less. The fall is less. The increase is more because there is an increasing trend. So there may be a short dip, but over a period of time, what is the indicator? It is moving upwards. Okay, so that is what is the primary trend. The secondary trend acts as a restraining force. I'm using the word here, restraining force. This is also given in your study material, which I've given to you. The PDF format is given to you now. So even if you open that, you will find that these terms are used: restraining force, restricting. So as I told you, first day it is increasing by 20, second day it is increasing by another 10 rupees, third day it is increasing by 15 rupees, fourth day it is falling by 5 rupees. So restrain. It has been restricted. Up, 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 small down. Restraining force on the primary trend. It tends to correct deviations. That means what happens is sometimes people are in a particular mode of going on buying. One person is buying, the other person is also buying, third person also buying. So because you are buying, I am also buying. That particular mentality goes on increasing every day. But then that is not the actual correct value of the stock. So there must be some correction made. So automatically there will be some investors who are intelligent enough, they are looking at the stock market and they will be saying that okay, array, these people are just going on buying, valuations are very high, shares are not worth that price. So as the prices increase, some of them will start selling and bring it down. Because when you start selling, what happens? Supply increases, demand is less, supply is more, price comes down. So these are deviations or what we call as corrections. So you will use this term, when you're looking at the financial news or reading financial news, you may find that corrections happened in the market today. Means what? That as the prices were going on increasing, suddenly there is a small dip. It comes back. Sometimes, in our human nature also, what happens? We go on acquiring knowledge, go on acquiring knowledge, and we feel that array, we are, our attitude also changes. Our attitude changes. I'm giving one exam after another exam, and I'm, getting success in every exam that I'm sitting for. So my attitude may change. I may become arrogant. Ego may come. I may start looking at people, that array, these people are nothing. I'm the person who has got the full knowledge. So I may have that ego, and that ego goes on increasing. Then suddenly one exam when I writing, I don't clear this exam. I'm not able to clear the exam. So it means that there is a sudden failure. See, I may have cleared my 10th standard with 95, 99%. PUC second year, I may have cleared with, you are recollecting your days, na? So PUC I may have cleared with another 99%. Foundation, CMA foundation also I cleared with good percentage. First shot I cleared. Inter CMA, sir, second attempt I cleared. First attempt they did not pass me. You will not say that I did not clear. You will say they did not pass me in first attempt. Correct, na? So now there is a small, you can say, a rejection. You have not been able to clear the exam. You are getting success. Suddenly there was a downfall. Then you realize, sorry, now this is a professional exam. I cannot take it like my BCom exam. So now you start putting in more effort. So that correction has come, that you are going up the slide and you are going up the ladder, and then suddenly you felt that you are the know all and the end all. You are the scholar. So suddenly CMA enter, the results are not so good, and you are brought down to your level. So correction was done, and then you put in more efforts, and then you clear again. So it is like that. Correct deviations, intervening movements in prices which last for a short period. Last for a short period. It is not a long-term situation, but it is running counter to the primary trend. That means it is along with the primary trend. It is not separate. It is along. So in a bull phase means what? Increasing phase. In primary movement, after a rise in the prices, there will be a fall in the prices. This fall in the prices is called a secondary movement. But will it fall to a large extent? Suppose the prices have increased by over a period of time, it has increased by 50 rupees. Will it fall by 70 rupees? No, it is not going to fall by 70 rupees. If the prices increase overall by 50 rupees, it may fall by minimum 33% or maximum 66%. That is actually 33 1/3% and 66 2/3%. So for convenience purpose, I've said 33% and 66%. Okay, so it may increase by say 50 rupees. When it falls, it may fall maximum by 30 rupees, 32 rupees. Followed. So the fall is not as big as the increase. That is the secondary movement. That is the secondary movement. Okay. So now let us see this in the form of graph. In the graph, you'll be able to see this. Dow theory. What is it showing? What is this graph showing? This is one is a industrial average and one is a transportation average. Dow Jones has they have actually developed this for two separate purposes, two separate service sectors. One is an industrial sector, one is manufacturing sector, one is service sector. So transportation, you can see a Dow Jones transportation average. Here it is Dow Jones industrial average. The first one is industrial average. Second one is the transportation average. Now, what you can see, primary movements, day-to-day movements, day-to-day movements. These are day-to-day movements. These are day-to-day movements. And then over a period of 1 week, you can see that over a period of 1 week or over a period of number of months, you find that this has been the change over a period of 12 months. Then over a period of, that means what is happening? What is the trend over here? It is increasing trend. It is increasing trend. So initial movements indicate increasing trend. Achha, now let us come to the final point here. Final point is up or down? It is up. That means the initial trend showed that the entire movement is going to be an upward movement. Okay. Now it went over here. Now you can see one line is drawn over here. Okay. One line is over here. It has stopped over here. Then it has come down. It has come down here. Then again it is going up. Again it is coming down. Again it is going. So the downward movements are less, are smaller. The upward movements are bigger. But here there is a big downward movement. But then upward movement is also bigger. Here there is a downward movement. It has come down. So again one line is there. We'll come to these lines also. These lines. Again there is a down. We have reached the lowest over here. Then again it has started increasing. Because overall trend is what? Overall trend is to increase. Overall trend is to increase. So over a period of 3 to 4 years, let us say this particular period, I'm taking this period from here to here. If I'm taking these 5 years, then what do you find? It is an upward trend. Here also, what do you find? It is an upward trend. So when there is a change, there are three types of movements. Initial movement, day-to-day changes, day-to-day movements. That is called as primary movement. Then as that will indicate the trend. So if it is an upward trend, then there will be a secondary movement which will bring down the upward trend by a small margin. Then again it will increase. Then again it will come down, again it will increase, again it will come down, again it will increase. But the downfall is less as compared to the upward movement. So that shows that there is an upward trend. But the initial movement shows that there is a downward trend. Then what will happen? The reverse will happen. So as the price has gone falling, 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 suddenly you will find that one fine day the price will increase by a small margin. Then again it continues to fall, fall, fall. Again one day or some investors feel like buying the shares, the prices will increase. So like this, there will be alternate changes in the prices. Now I have made use of two terms, bull and bear. So now if you go to ask me what is bull and bear, or if I ask a student what is bull and bear, and I ask the student to draw the figure of a bull face and a bear face. What the student does, he will come to the board. I give him the pen, and with the pen he shows the bull face. He says, "Sir, bull is like this. So this is a bull. This is what he says. So this is a bull." And I ask him, "What is a bear then?" He says, "Sir, downward falling is bear." But now you have to understand, since you are doing a professional course, since you are doing the subject of financial management, strategic financial management, what is the meaning of strategic financial management? Because we are going to strategize now. Financial management you have done, inter CMA you have done, financial management. What is strategic financial management? Strategic financial management means that you are strategizing. So you have to have insights. You have to have in-depth knowledge, technical knowledge of the terms. Otherwise, you will not survive. Followed. So what I will be doing is I will have to know what is the meaning of bull, what is the meaning of bear. Now you say, sir, what is wrong in the diagram? You said that bull phase means the prices are going to increase. You said that bear phase means the prices are going to decrease. So I've drawn an increasing stage here. I've drawn decreasing stage here. What is wrong in that? What is wrong in that diagram? You say, sir, you draw a bull diagram. So I draw a bull diagram. How will I draw a bull diagram? I will draw the bull diagram like this. Will say, sir, what is the difference, sir? You also are showing the same thing going upwards. We also have shown the same thing going upwards. Okay. What you have done is, I have taken you outside a building and I said that, suppose your name is Mr. Ashok. I say, Ashok, I want to go to the third floor. Or I tell you, Ashok, you have to go to the third floor. What you have done, you take a big ladder, you keep it outside the building, and you climb the ladder and go to the third floor. That is what you have done here, climbing the ladder, going to the third floor. You say, sir, you also come. I say, no, I will not come by ladder. I will come by steps. Are building steps are there now? So why to climb the ladder? So I climb the steps. So steps are, I take the first step, then I go up, then again the second step, and the third step, and I reach here. What is the difference? So both of us have reached on the third floor now. But you have reached via the ladder when the steps are there. I climb the steps. Acha, now what I want you to observe here, and what is the meaning of bull phase? In bull phase, I tell you that every successive high, every successive high is higher than higher than the previous high. Every successive high is higher than the previous high, and every successive lows are also higher than the previous lows. Sir, did not understand. Please explain. I am explaining. Every successive high is higher than the previous high. This is the first height. This is the second height. This is the third height. This is the fourth height. Every successive height, every successive height, 2 is higher than 1, 3 is higher than 2, 4 is higher than 3. So every successive high is higher than the previous high. Can you explain that over here in this figure? No. Where is the high and low there? There is only one high over there. It's only high, it's not low. Every successive high is higher than the previous high. So 2 is higher than 1, 3 is higher than 2, 4 is higher than 3. Then what did I say? Every successive lows are higher than the previous lows. Which are the lows here? A, B, C, and D. What do you find? B is higher than A. All these are lows. All these are lows. But B is a low which is higher than A. B is a low. It is low, no? It is down. But this point B is higher than A. Achha, C is also coming down. It's a down point here. But C is higher than B. D is higher than C. So every low is higher than the previous low. Understood? So bull phase means you have to understand this. I will give it to you. I will give you the point. Bull phase means what? Where every successive high is higher than the previous high, and every successive low is also higher than the previous low. Clear? Absolutely clear. Every successive high, 2 is higher than 1, 3 is higher than 2, 4 is higher than 3. Okay, so when I'm explaining now, you're having your notebook with you. You can just make a rough, note of this particular point, because words are there, explanations are there. But then, if you write it down in the form of figure, you draw that and you write it down on your book, then only you will understand. Write and practice, write and study. This is what I always tell my students. Even theory papers that you are doing, now audit or law or some other paper that is there, I tell the students, don't read and study, write and study. Because when you write and study, it makes sense to you. Okay? So, bull phase means what? Every successive high is higher than the previous high, and every successive low is also higher than the previous low. Point is clear. Absolutely clear. Now, bear means what? This was your figure for bear, downward sloping. Now you got the idea, na? Now you know how to draw the figure. Okay, let us see. Bear means what? Bear phase is something like this. This is a bear phase. Is this different from this? Yes, it is different. This figure is wrong. This figure is correct. So now, as I defined the bull phase, how will I define the bear phase? The bear phase is one in which successive highs, which are the highs here? These are the highs. One, two, three. These are the highs. Okay, where every successive high is lower than the previous high. Every successive high is lower than the previous high. So 2 is lower than 1, 3 is lower than 2. Which are the lows over here? A, B, C, D. So in a bear phase, every successive low is lower than the previous low, is lower than the previous low. Followed point? So bull phase and bear phase. We use these terms in day-to-day life, but very rarely when it comes to when you are going for an interview, your interviewer asks you, you know what the stock market? You say yes, sir. You know what is a bull market? You say yes, sir. You know what is a bear market? You say yes, sir. He says, okay, now go and take this pen and show me how the bull market looks like. You draw a line and come. That shows that you have not understood the market. You have not understood the concept. Concept is very necessary for your being a professional. That is why I say that my students, anywhere I go, I tell them what I'm doing. They tell me, sir, you are doing concept based teaching. So, concept based teaching means what? This concept based learning means what? That you are learning the concept, what word you are using, what particular technical term you are using. You should know the actual meaning of that. Then only it makes sense. Now, otherwise, BCom student also will know bull and bear. They are a bull and bear. I know those are two animals. Right? These are not two animals. These are two phases of the stock market. So you are a professional. So you will tell them that this is a stock market term. And what do we understand? That you have to tell them. So let us come to the concept of bull phase and bear phase. I told you, I gave you the diagram, I explained the diagram. Now let us see the theory of this. What does it say? It says bull phase is one in which the succeeding highs exceed or are higher than the preceding highs, and the successive lows are also higher than the preceding lows. Bull phase is one in which the succeeding highs exceed the preceding highs, and the successive lows are higher than the preceding lows. Bear phase is what? In which the succeeding highs are lower than the preceding highs, and the succeeding lows are also lower than the preceding lows. So this is how we define a bull phase and a bear phase. Any difficulty? I'm sure you have understood this. So with the help of the diagrams that I've shown to you, bull phase, bear phase, it's very easy. When you're watching a video, suppose you find that you want to come back, you just rewind. Na? There is nothing to get frightened. Array, that particular topic is gone, that particular point is gone. Come back to that point. You can rewind a little bit. Come back to that point. Again, go through that point, go through the example, go through that diagram. It is there. It is not gone anywhere. So that is the benefit of recorded lecture. That you can come back to it. Isn't it? And as I said, any particular doubt or problem or anything that is there, you want to ask, there is a comment option below the video. Write your comment over there. You find that lectures were very good or solid here. Then also you can write over there, sir, thank you very much. Lectures were excellent. You will write, okay. So now let us come to, in the first diagram, there were lines which were drawn for the heights and for the lows. I take that particular part now separately and see how it is to be interpreted. Okay. So interpretation of certain things which are there in that particular diagram. Let us see how to interpret this. What do you find now? You find that there is one red line that is drawn here and here. And what is that red line doing? It is touching the topmost points over here. So this particular red line that I'm drawing here is touching 3 points here. This is point number 1, this is point number 2, this is point number 3. Okay. So all top points are touched. Now again this particular line is touching two top points here. Point number 4 and point number 5. The 5 heights are there. So what do you find now? You find that heights are taken, we draw a line touching all the heights here, we draw a line touching all the heights here. What have we done here? The green lines which are there, green lines which are there, green lines which are there. How many lines are there? 4 lines are there. Okay, so this is the first point of fall, I'll call it as A. This is the second point of fall, I'll call it as B. This is the third point of fall, I'll call it as C. This is the fourth point of fall, I will call it as D. And this is the fifth point of fall, I will call it as E. So now what has happened is, if you look at it, initially the prices went up. Initially the prices went up here. After that it started sliding down and it reached this point. It was not going below this point. Okay. So there was the prices were falling at this level, at this level, at this level. It started falling. And after it started falling, there was some resistance over here. Resistance in the sense that I don't call it as resistance as such. When some object is falling from top, some support comes. Let us say that you are falling from a table. You are standing on a table and you lose balance and you fall from that table. So as you are falling to the ground, somebody holds you. As you are falling to the ground, somebody holds you. What happens? You get a support. What do you get? You get a support from falling further down and breaking your head. So in the stock market also, when the prices are falling, somebody will be there to stop it over here at point A and say enough is enough now. I am coming into the market, I will start buying and I'll increase the price of the commodity. I'll increase the price of the share. So there will be somebody who comes to the market and says that enough of decrease now. Prices are already come down below the levels required. Now we will increase the price. So there is a support level. What is it called? All these green lines, they are called as support levels. Support levels. Support levels are rock bottom levels. Rock bottom levels. And once the stock reaches that rock bottom level, it is likely to rebounds. When you throw a ball, tennis ball, when you throw the ball to the ground, what happens? It comes back again, isn't it? So it bounces back again. The support level is the price level where after reaching the lowest point, the price bounces back. The price bounces back, which means that once you have drawn, the feature of support level is that once you have drawn this particular point A and you have got this point, the lowest point ever happened. Achha, now what is going to happen is, in future, after first of all, two things are going to happen. In first, once it reaches point A, there is a bouncing back. It goes up. It goes up. After going up, after some months, after some years, again it falls. Again it falls. It will not come down to point A. It will not come down to this level. It will be restricted somewhere before that. And worst scenario, if it happens, then it will come down to level A. So level A is the lowest form or lowest point at which your stocks can ever fall. Your stocks can ever fall. It will never go below that. Now, for example, COVID-19, because of that, this coronavirus, stock market has fallen. From 40,000, it came down to 23, 25,000. Will it become zero, sir? Never it can become zero. Never it can become zero. I am telling you, stock market will never become zero. Sensex will never become zero. Whatever happens. So that means there is some support level. You found that in between, again the markets increased by 2000 plus points. Again the market increased by 1200 points. So some good news is there in the market, again it will increase. That support level is the lowest level below which the stock will or the Sensex will not fall. Achha, now what are these points now? This 1, 2, 3, 4, 5, 6, 5, sorry. These are the points which are maximum levels. Maximum levels. When it reaches that level again, there is some resistance. There is some resistance. Something stopping it. Something stopping it from going, directly zoom up. So there is some force which is stopping it. That particular force or that particular level where the prices cannot go up. It cannot go up. There is some resistance. There is some resistance. So that level is called as the resistance level. Okay. So now let us see the theoretical points of this. Support level first. When the index or the price rebounds after reaching a trough means the lowest point, the bottom point, the lowest value reached becomes the support level. What is a support level? A support level is a price level where the price finds support as it is going down, as you are falling. I give you example. Remember the example, you will understand the concept. As you are falling from the table, somebody holds you down and you don't fall on the ground, you fall in the hands of that person. You must have seen movies now, heroine is standing and doing some work on the ladder and suddenly the heroine falls. And luckily at that particular point of time, God sends the hero and the hero catches the heroine. Does not allow the heroine to fall. Correct now? So that is support. That is support level. This means the price is more likely to bounce off at this level rather than break through it. However, once the price has passed this level, by an amount exceeding some noise, it is likely to continue dropping till it finds another support level. It will go on falling. There will be some support, again it will fall, but the lowest point will be the lowest support level below which in future also it is not going to fall. Let it reach the lowest point, after that it is going to increase, and after increasing in future if it falls it will not come down to that level. That is support level. What is resistance level? It represents the peak value, topmost value from which the index price goes down. After that it comes down. Resistance level is where the price tends to find resistance as it is going up. This means the price is more likely to bounce off this level. Again, it is going to bounce off this level rather than break through. However, once the price has passed this level by an amount exceeding some noise, it is likely to continue rising till it finds another resistance level. So in the diagram you have seen. Now all these diagrams, all these points, all these diagrams are there in my material which is given to you. So nothing to fear, nothing to worry, sir. I don't have the diagram. I did not have time to copy. Don't worry. Diagram is there in the book. Points are there in the book. I'm explaining the points. Okay, like this, there are several concepts which are going to be there. Like this, there are several concepts which are there as far as the stock market is concerned, as far as security analysis is concerned. Any problem? No, no. Everything is going on smoothly. Now you are not knowing these terms in the beginning. So now you have got to understand these terms. Now you will understand that there is a lot to stock market than what we hear and see on a day-to-day basis. Clear? Shall we go to the next part? Shall we go to the next part? Okay. Next concept that I want to do is called as Bollinger Bands. What is it called? Bollinger Bands. First, I will tell you, we'll do the theory of this. Then I will show you the diagram. You will understand everything. Okay? Bollinger Bands. Band, rubber band. You hold the rubber band like this. Okay? You put it to your two fingers here, two fingers here, and hold it like this. What happens? That's a rubber band. You say, this is a rubber band. What is the rubber band representing? It shows the space between the two sides. So like that we have got Bollinger Bands representing the space between two lines drawn on either side of the simple moving average. So if I just draw two lines like this, and there is something between here. So those two lines which are drawn, those are the Bollinger Bands. Now, what is the specific reason why I'm doing this? What is the meaning of this? What is the significance of this? It consists of a center line and two price channels, one above and other below. One above, other below, and there is a centermost line in between. Now this centermost line is not going to break either of the two. It will remain within that boundary only. So it is like the boundary. Bollinger Band is like the boundary. The price channels are standard deviations of the concerned stock under study. Okay. Now, will these bands expand or contract? Answer is yes. It may expand, it may contract. If the volatility of the stock is more, it will expand. If the volatility of the stock is reduced, it will contract. Okay. So now let us see how does the Bollinger Band look like. Wow, what a figure. Bollinger Band, you can see now three curves are there. The outermost curve here, this particular curve that is there, this is the Bollinger Band here, and this curve here is the Bollinger Band. Now there is something in between also that is called as the SMA. It is the stock price that is fluctuating. Now, how did I get this? This is the simple moving average. SMA means what? Simple moving average. Price of the shares are increasing. It is increasing like this. It is coming up here. It is coming down here. Coming up here. Coming down here. Coming up. Now, this highest point here, lowest point here. On that basis, I have drawn the Bollinger Bands. Here, it is not crossing this. Here, it is again crossing the share prices that you can see. It is over here, share price. Here, the share price. So it is not going beyond the Bollinger Band. So it is, I draw the Bollinger Bands in such a way that all the curves are covered. All the ups and downs are covered. And then the simple average of all those movements, upward, downward movements, that is your SMA line in between. This is your SMA line. So this line is the SMA line. This is the boundary, Bollinger Band. This is the Bollinger Band. Okay. So this band will increase. This breadth of the band is this much. This band can increase in volume. When it will increase? When the volatility is more, when the prices move more out of this range, then the bands will expand. And as the prices further narrow down, it will contract. Okay? The bands will expand and contract as the price action of an issue becomes volatile or becomes bound into a tight trading pattern contraction. Since standard deviation is a measure of volatility, Bollinger Bands adjust themselves to the market conditions. When the markets become more volatile, the bands widen, and during less volatile periods, the bands contract. Okay, so these are some of the things that we have seen as far as the concepts are concerned. Now, much more things than this. Stock pattern. This is one pattern which I've shown to you in the form of a Bollinger Band. There are other various types of stock patterns, movements of stock prices, which take place in some particular format, and we give them names. We give them names. Okay, so let us see now what are the different patterns in stock prices. The different patterns in stock prices which are arising because of different factors, and how do we interpret them? That is what we have to see now. Okay, ready for that? Up till here, everything is clear, I suppose. You are enjoying all the diagrams and the explanation. You have learned something new today. Yes, now. Different patterns that we are having in the stock prices. As we said, stock prices may increase, may decrease, and over a period of time, you will find that there are some patterns which are evolving, some design, some pattern, which we can identify in the entire movement of stocks, and we can give it a name. If we find that, we can give it a name, identify that particular movement, and try to interpret that movement. That is very important, interpretation of that movement. So what are the different patterns in stock price? We'll take some simple basic ones, and the remaining you can study from your material that I've provided to you. The first thing that I will start with is wedge, not vegetarian wala wedge, wedge, WEDGE. This particular wedge is a pattern that is something similar to, you can say, a symmetrical triangle, that it slopes upwards or downwards. It is very difficult to identify sometimes this particular pattern, which means that we do not know as to when this particular wedge will really take place. Wedge is nothing but an upward slope or a downward slope. In simple terms, a wedge is an upward slope or a downward slope. So, if I'm talking about a wedge, it is a pattern which is a reversal or less commonly continuation pattern that's similar to the symmetrical triangle, except that it starts upward, it slants upwards or downwards. Okay, so we have slants upwards or downwards. This is very important. So you can have a wedge that is sloping upwards, or you can have a wedge that is sloping downwards. Now, what is the indication of this? What is the meaning of this? As I told you, it is very difficult to identify such wedges. But as I said, if you see the definition here, they have given it is a reversal. Okay, reversal means that once you have, suppose you have a wedge which is an rising wedge or an increasing wedge, then in that case, I say that as the wedge is increasing, it means that after this wedge is over, at the end of this wedge, there will be a downfall. That means there will be a bear market. Now we know the terms. Downfall means bear market. So we'll have a bear market which is going to follow immediately after this wedge, a rising wedge. If I'm having a rising wedge, then it means that immediately it is going to fall. Suppose that in the same way, if I have a falling wedge, then it means that there is going to be a bull market in the future. So that means it is going to increase. Okay. So the interpretation, or you can say what is called as the significance of learning this wedge. The wedge pattern can be very difficult to identify and trade, which means it's important to look for confirmations in other technical indicators. That means wedge by itself cannot be an indicator. I cannot say that always an upward movement will lead to a downward movement. You have to identify and signify, learn this particular pattern along with other technical details. Okay, we can have a rising wedge or a falling wedge. Now, let us see how does a rising wedge look and how does a falling wedge look. Okay, so we'll take the figure. This, if you can see here, it is a rising wedge. What do you find? There is a pattern. What is the pattern? The pattern is that all these prices are indicating that it is increasing. Even if there are downfalls, there, as I said, it is a bull market. How do you know it is a bull market? That it is going to increase, the every low is higher than the previous low. That is a bull market. So it is increasing, increasing, increasing. But what is the feature of this wedge now? You find that it is narrowing. The gap is narrowing. This particular gap, it was very wide over here, it is very narrow over here. So it is this wide, and it is starting with a wide gap, and then that gap between the changes in the price, it is going on narrowing. And since it is going on narrowing, you can interpret, it is very difficult, but you can interpret if you are very closely observing the stock market. It is very easy to identify these trends. So you can find that this trend is there, that it is increasing, and that that particular gap is decreasing. That gap which was initially wide gap, now that gap is decreasing. So it is becoming narrower and narrower. Then it means that, it signifies that the increase is going to stop now, and it is going to now have a downfall. So rising wedges are bearish. Normally students make this mistake. They feel that rising wedge means it is increasing. No, it is bearish. That occurs when trend is moving higher and the prices are converging. That means they are coming closer and closer, closer and closer, narrowing the gap. And the prevailing trend means existing trend is losing momentum. That means it is losing its speed, it's losing its strength. So it is going on increasing, but it is losing its steam. Okay, so that is called as a rising wedge. Likewise, we have a falling wedge. So that means here also it is decreasing. But what do you find? That this gap over here is very large. The gap narrows over here at the end. That means towards the end it is going to fall, and then it is going to rise again. There will be a bull market again. So that is the significance, that is the implication of a falling wedge. So falling wedges are bullish in nature. When the trend is lowering, moving lower, the prices are converging. This is very important. Prices are converging. Then the present trend, the bearish trend, is losing momentum, and a reversal is likely. Okay, so these are all the patterns that you can see if you are looking very closely at the stock market movements. If you are sitting before the NSE, if you are sitting before the BSE, that entire chart comes up to you as to how the stock is moving. Now, in that particular, you can select a particular stock, and on the NSE website or the BSE website, and you can see the pattern of the movement of the stock over a period of 1 week, over a period of 1 month, over a period of 52 weeks, that is 1 year, and so on. Okay. The next pattern that we have is head and shoulder. Head and shoulder, not a shampoo. Head and shoulder movement. How do you find this head and shoulder of mine? This shoulder is there, then it is going up. This is the head, and then it is coming down to the second shoulder, isn't it? So you have, it is like a mountain, it is like a normal curve distribution drawn. You remember normal curves, no? Right? So this is the format. What do you find? Shoulder, head, and again shoulder. So this is the head part. Okay. Now this particular line where the shoulder comes down, shoulder is over here. It is coming. It is like this. Okay. If I'm sitting like this, the shoulder is coming up here and it is coming here. From here the next starts. From here the next starts. Again it comes down here. Then again from here the neck starts. Okay. So likewise your neck portion is here. This is the neck portion. So the line joining the two parts is called as a neckline. These are the two humps which represent the shoulder. These are the two shoulders. This is the top part, that is the head part. And this particular line, if I draw, joining these 2 points, joining the end points of the head and the shoulder, that is called as a neckline. Now, if the after this particular pattern occurs, see what is the significance of this. After this particular pattern occurs, at this particular point, this is the end point now, after drawing the neckline. If the next movement is above over here, the next movement is here, then that means it is going to rise in future. That means it is going to increase in future. The price is going to increase in future. But now what has happened in this diagram? It has come below the neckline. The prices have fallen further. That means now it is going to be a downward trend. It is going to be a bear phase, not a bull phase. It is going to be a bear phase. So this will determine the head and shoulder is a price pattern which resembles a distorted drawing of a human form. A child is drawing the face of a man, and when the child draws, he just draws rapidly, so he doesn't care for all the important things that you have to draw it very decently, very nicely. So he just draws. If you ask him to draw a man, he will draw a man like this. So you ask him to draw head and shoulder, he will draw like this. Okay, he will draw something like this. This is shoulder, this is the head, and this is the shoulder. So he will draw something like this. So distorted. Distorted means not wrong. It is a rough figure with a large lump for head in the middle for two smaller humps for shoulders. So this is called as head and shoulder. Likewise, we are having different patterns which are there. The different patterns can take the form of, you can refer to our material. I've given all this in the material over there. So the other form, neckline of the pattern, see this, I've told you the neckline, this is the neckline, is formed by joining points where the head and shoulders meet. If the price goes below the neckline, then a drop in price is indicated. So here it is going below the neckline. So a drop in price is indicated. And if it is going above the neckline, then it will be a rise in price. Other forms, we have a triangle formation. See triangle formation. It is increasing, then decreasing, then increasing. Again, but this is what I told you. A wedge is similar to a triangle. Wedge is similar to a triangle. So I'm having this type of triangle here. Triangle can be a symmetrical triangle. Okay, symmetrical triangle means that all the sides are equal. So this portion, and this portion, both are all three are equal. Symmetrical triangle. Ascending, that means it is going showing on upward movement. See the upward movement here. You can see the upward movement here. Okay. So it is going to go on increasing. Then you can have a downward facing, that is descending triangle. So you can have three types of triangle: symmetrical triangle, ascending triangle, descending triangle. Likewise, we are having a lot of formation. This is another triangle formation that is there. Okay, flags and pennant, flags and pennant. This is like a flag, no? Flag. Okay. So different forms are there, different formats are there. So like this, you will find different diagrams which are found in which are there in your material which are provided to you. So you can just give a reading to that. So the main parts I have done with you. What are the main parts? The main things are triangle formation, head and shoulder, not triangle formation, head and shoulder, and then you have wedges, increasing wedges and falling wedges. All these things are important. Okay. So with this, we have done most of the parts of security analysis. I think security analysis, if you see now, the analysis part is over. We have got two parts to security analysis. It is security analysis and valuation. Security valuation is there. So in the next session, in the next lecture, I will be taking up the security valuation part, that is calculating the price of equity share, calculating the price of preference share, calculating the price of debenture, and so on and so forth. So for that, I just want you to revise your inter CMA financial management. If you have maintained the books with you, the topic of cost of capital. Cost of capital, remember? So topic of cost of capital, you have to do that, you have to revise that when you come for your lectures. That is the third lecture. This is the second lecture that I'm concluding. In the third lecture, you will be requiring those formulas to just revise those formulas. Now I am uploading this lecture today. This will remain for 48 hours. That is by Sunday, lecture 1 and 2 will disappear. And you will be having only lecture 3 uploaded. That is tomorrow, mostly I'll be uploading lecture 3. All the details regarding lectures will be provided to you in the WhatsApp. All your difficulties, I'm stressing again, all your difficulties should be put in the form of comments, which option is available on the below the video. And even if you like the lectures, write over there, because I want to know whether you are actually going through the lectures, viewing all the lectures till the end. Okay? So till then, till the next lecture, stay at home, stay safe. God bless you.